Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and I run the Cyclical Investors Club service. Today, we are going to be looking at PayPal stock, and this video is about 3 years in the making. I always like to start my videos by reviewing any previous coverage I've had of a stock, and there was about 3 months in 2021 where I posted several videos on the channel here when I first started it. And PayPal was one of those that I warned people about. Let's see the title, and you can look it up. It's still on the channel. Why it's time to take profits in PayPal was the title of the video, and it came out on February 6th, 2021. As always, this isn't individual investing advice. This is just how I analyze stocks. And in that video, let's see if we can find it on the fast graph. Let's see, February 6th, February 5th. That's probably the closest I'm going to get. So put that warning video out for folks then, and now PayPal is 77% lower. So now since that time, I've actually written quite a bit about PayPal, and then I just recently put another PayPal video out last month by request. If you have a request for a stock you'd like me to analyze, just put it down in the comments. And if it's in the S&P 500, I post those here on YouTube for free. And if it's not in the S&P 500, I post those on Patreon and in the full Cyclical Investors Club service. And I'll have those links in the description. Okay, and then on Seeking Alpha, let's see if I have that pulled up here. So I've written 4 articles, and these are after my sell video on the YouTube channel. So later on in 2001, this is kind of a all technology stock warning there. And then I explain why I haven't bought it yet in 2022. And then I say it's getting close. And then I talk about some of the factors earlier this year, investors might want to consider before buying. So this has been, I always like it when I can warn people ahead of time of the dangers, and PayPal's danger was just that it was very overvalued. It had a 68 PE, earnings were growing. I usually max out my earnings growth estimates at 20%, so I never assume they'll grow faster than 20% for more than 10 years, because I use a 10-year time frame when I'm kind of extrapolating everything out. So using that method, and you can go watch the video if you want to kind of see what I was thinking at the time. It just seemed obvious to me that, now was the time to take profits if you had made a bunch of money during the pandemic. I mean, if you had it before the pandemic, you would have made over 100% in like a year or something like that. So that was a good call. But then the question comes, okay, now we're down here and we're at like maybe attractive levels, unless things just totally fall apart. So I'm going to do my valuation analysis here. And for that, I'm going to be more conservative than the adjusted earnings, which are $4.98. I'm going to use basic earnings to try to be a little bit more conservative. Those are only $3.75 a share for this year. Now you can see that the basic earnings actually kind of correlate to the stock price. I mean, they aren't as big as the stock price movement, but the direction correlates. So when we got this big jump, we got this big jump in the stock price. When they flattened, we got this flattening in the stock price. When the basic earnings fell, we got this decline in the stock price. And now they're bouncing back, which is interesting, but the stock price is not bouncing back as quickly. And so that could be an opportunity if this is a trend that they can keep going. So my biggest kind of thing that was holding me back here on PayPal was just kind of the recession risk that we might have. And I think after this last Federal Reserve meeting, the reaction to it where interest rates, long-term interest rates, came down a lot. What that does basically, if interest rates keep kind of coming down every now and then, it gives people and businesses a chance to refinance if they have a higher interest rate. And it just kind of stretches out the longer you can people and businesses and everything can go before those credit pressures in a normal kind of debt cycle kind of hit that tipping point. So even though the Fed didn't change rates, the rates did drop on anticipation that they would. Now this could whipsaw around a lot, but in terms of rates, but because inflation might not go down as fast as people are expecting. But the thing is, the longer this process goes on, the more a potential recession gets pushed out, and the less likely of a really deep recession there could be. So for me in 2022, you actually do see it with PayPal's earnings. I thought that this was a very dangerous time in 2020, going into 2022, especially once Russia invaded Ukraine. We had the potential of student loans being paid back. We had an energy price shock that was sort of happening. We still had some supply chain snarls, and we didn't know exactly. And China wasn't reopening very quickly, and we had political gridlock, so there wasn't any more stimulus coming. So when you put all those together, if they all would have hit at the same time, we would have had a bad recession. So I'm the type of person that I like to be prepared. Whether the perfect timing comes out or not, if it looks like that the chance is high, I like to be prepared. So I've had quite a bit of cash during this time. And I've avoided stocks that have the potential to do what PayPal has done. But because student loan payments got delayed, because we did pass some, not individual stimulus, but we passed other types of government spending, that, for infrastructure and things like that. So everything wasn't like completely cut off. Fuel prices have come down. Interest rates have at least come down for a little while. And again, these things could always spike back up, but, and because student loans were kind of stretched out for so long, now kind of everything's not going to happen at once. It might still happen. It might still build up. Debts are building up with people. Defaults are back a little bit above, I think, for some companies, some credit card companies. I saw Synchrony Financial came out, and they were a little bit higher than 2019, like pre-pandemic. So we're back on that kind of debt building up and becoming potentially a problem trend. But if rates keep coming down and kind of keeping everybody can kind of hang in there, then that really deep recession, like 2008 type thing, is less likely to happen sooner rather than later. So because of that reason, I've loosened up just a little bit here, because the numbers on PayPal looked pretty good, but I was really waiting on the momentum to change. Now, technically, the momentum on the stock has not officially changed. So I'm getting a little bit ahead of things here, but we do see some signs of life. I mean, it bottomed at 50. It's at 61 now. So what's that, like 12% higher or something? I don't know. My math isn't. Yeah, more like 20. Yeah. So, there's a little bit of life potentially there. The earnings look good. So that's kind of the big picture setup that I'm thinking for this. It doesn't mean we won't have a recession at some point. It doesn't mean PayPal is going to just immediately take off. But I do have quite a bit of cash. I think I'm at 40% now after this purchase. So that's kind of the big picture setup here. And I've talked about the earnings and everything in my other videos, but I'm going to run through it again here. So if you use basic earnings, the PE is 16. It's only 12 if you use adjusted. So I'm being conservative. Also, I'm going to go back to the adjusted earnings really quick. This is probably about the same. It's, let's see, 9 and 15 for the growth rate looking forward. And I'm going to use a 12, which is 12% earnings growth rate assumption. And that's right in between where analysts are for the next couple of years. So I'm basically spot on assuming what analysts think it will grow at. If you look at what it's grown since it's been public here, it's grown at like 17%. When I first looked at PayPal, I assumed it would grow 20%. Then I lowered it to 15. And then for a while I had 10 because I wasn't sure what this downturn was going to look like. And so right now I'm basically at 12. I'm right in line with kind of where the analysts are. I feel like that's as good an estimate as you can probably make. And so that's how I'm running the numbers here. So basic earnings to price. If I get my spreadsheet to load, I will look at it. Okay. So As you can see, the momentum score is still quite low. But if we use $3.75 in earnings, we get an earnings yield of 6.12. And I assume this is going to grow at 12% a year. So the way I like to think about this is if I bought the whole business for $100, it would earn $6 the first year, and that $6 would grow at 12%. I actually pull the first year of earnings growth forward. So I assume you get $6.85 the first year, and then that $6.85 grows each year, and it accumulates, like you accumulate it. So the next year you have $6.85 plus $6.85 and 12%, which is $14.53. And then you start off with your $100 investment, right? So we do that for 10 years. We get out here, we have $220 and 59 cents after 10 years. Obviously 100 of that is your initial money. So if you put this in a CAGR calculator, you start with 100, you end with 220 over 10 years, and that's how you get this number right here, which is my business owner 10-year CAGR expectation. So if this is over 8%, then that's kind of my buying threshold, basically. So it's a little over that. My buy price, I think, what are we using here? 63.60 is my current buy price. And so we got a little bit of it's a little bit below that now, so it's a current buy. I mean, anywhere kind of in this range, I think below this price is probably a decent buy unless something really bad happens. I'll probably make a video if something really major comes along. But really, you're just trying to get the odds on your side. I think the odds are pretty decent. I definitely think PayPal has challenges. They have challenges with competition. They have potential challenges with, government digital currency and things like that. But we don't really know how any of that's going to turn out. And I take 1% portfolio weighted positions, no more than 2%. I took a 1% position in PayPal. So one of the reasons I take these lower percentage weightings is because we don't really know with any particular company exactly everything that's going to happen to it. But I have a process where I try to just get the odds on my side, place my bet, and let it play out. And so with my style of investing, where I look at a lot of stocks, I basically try to look at the profiles that I want, at the valuations I want, where I think the odds are in my favor, and then I place my bet. It's a process over time, and I can judge it because I have a lot of stocks. I have a lot of sample size to look at and kind of see, okay, this is working or this isn't. So this is usually usually about 80% of the time I get positive returns. And then a lot of times, I significantly outperform with this particular strategy. One risk with PayPal is it doesn't really have good recession data because we don't have data going back before like 2016 when it was part of eBay. eBay wasn't super cyclical during the Great Recession, but PayPal was smaller and growing quite a bit different then, so I don't even know if it's comparable. But we are buying it at levels here that it was at in 2017, so 6 years ago. And so that's at least, and they aren't really earning, and they're earning twice as much money. I don't know let's look at the basic earnings too, just so we don't get too many adjustments from them. So 2017, they earned $1.49. Yeah, we're double the money, double the earnings at the same price that it was back here. So that's a pretty decent setup for me. All right, if you found this useful, hit the subscribe button. I put out videos nearly every day now, and I do take requests if you want to drop one down in the comments, and I will see everybody later. Bye.